Welcome, everyone. My guest today is Managing Editor James Kleimann to talk about the M&A deals we're seeing in the mortgage space, including some that haven't even been announced yet. James, welcome back to the podcast.
It's good to be back, Sarah. Thanks for having me.
Good to be back when we're not doing it 9:30 at night like last week.
Or while my house is in chaos. I just had to flea bomb my entire apartment because my cat came back from the groomer with fleas, and I have a toddler and a baby, and it's a whole to-do to try to get it set. So if I don't die of whatever chemicals I threw into my apartment by next week, that'll be a good sign.
That is a nightmare. Coming back from the groomer with that's malpractice. I'm so sorry.
No, the groomer found it.
Oh, okay.
So I think we had these. I have a Maine Coon cat, so he's huge and very fluffy, and it's hard to know because they have a double coat. So it's like
that is
way
crazy.
Deep in there. Yeah, and I just didn't notice. So
fun times for you. Well, we have some pretty interesting things to talk about today. Wanted to kind of take, from a broad stroke, looking at M&A deals right now.
Yeah, so we haven't seen a tremendous amount of activity, but it is definitely picking up a little bit. And I expect it is going to pick up a little bit over the next couple quarters. I think there was sort of an expectation at the beginning of the year, 2024 would result in just a mega wave of transactions. And we haven't really seen a ton of deal making. We have seen a couple smaller players, basically the story that you typically hear with M&A, which is a larger lender is gunning for market share and they pick up a smaller lender that is roughly similar in composition, right? So they're distributed retail or they're broker based or correspondent and they have a big servicing book, kind of like for like, right? We're starting to see things that are a little bit different now. And I think there are two interesting things to discuss here. The first is, where are we seeing the activity? And the second is, what does this mean for the refi boom that everyone expects is coming in just a couple months or, maybe early next year? So to the first question, I think one interesting thing that we've seen of late is companies that have strong liquidity. They have a lot of revenue coming in from MSRs. The servicing book that's kicking off 20, 50, 100, $200 million in liquidity per quarter. You can use that and you can fund other parts of your operation that are maybe not as profitable at this point in time. And so you're also, by doing that, you're fighting for tomorrow. So you're kind of bulletproof for today because you have the big servicing book and you don't see a tremendous amount of refis spread now, obviously more than what we saw last year, no doubt. But it's not like everyone and their mom is refining their 3%, 3.5%, 4% mortgages right now, right? So you have that, but there are going to be a lot of loans, not a tremendous amount, but a fair amount of loans over the next year that are probably going to be pretty good refi candidates. And then you also need to consider how many people just have credit card debt or have financial situations that arise and they say, well, look, I can reduce or consolidate my debt, and wrapping my mortgage is the best way to do it. So you have the benefit of being a large servicer with that liquidity right now. Mr. Cooper, for example, they just acquired Flagstar's most of their mortgage operations, with the exception of basically their branch retail, which is, it's a couple hundred retail LOs at the branch level in Michigan and other parts of the country. It's probably 10% of their business, I'd say, right? So for all intents and purposes, Mr. Cooper picked up Flagstar's mortgage operation. And what's interesting there is they're picking up about 1.3 million loans. And that's a pretty strong servicing book. Now, Mr. Cooper has overtaken JP Morgan Chase as the largest servicer in the country. And they have basically a retention rate of around 75%. And so it's companies like Mr. Cooper, it's companies like Freedom Mortgage. They have like a 90% retention rate. I mean, they're really incredible at being able to refi those loans that are up for grabs, right? And so this is the next fight And what's interesting is a lot of these large servicers, especially those who are buying, loans by the dozen, right? They're big correspondent players. They're doing Nondell. They're not necessarily having a team of originators in house that are at branch locations that are doing it, but they're acquiring these loans and they're saying, look, in a year from now, we have a golden opportunity. And what's interesting is a lot of the companies that do have large distributed retail or broker, footprints, they're the ones selling the loans, right? So the future battle is going to be, are you an LO who's either distributed or let's say you're at a broker shop and UWM sold, the loan, and Mr. Cooper bought it or Freedom bought it or PennyMac or whomever, right? And so a lot of loan originators, they think of the agent as their client, right? Like their job
Right.
is to service the agent to make sure that that agent is doing well and is supported through the process and continues to want to send them business. But now I think it's maybe a little bit different, right? You need to be thinking not only about the agent, and we'll set aside the NAR settlement for a second, but you have to be thinking about the client itself, right? The client, him or herself. And how do you get them before Freedom or Mr. Cooper or PennyMac or Planet or whomever is there to get them?
I think especially so when we had our AI summit, one of the things that we had several people speak about the fact that we are going way beyond the normal, like, here's your lead, here, oh, here's what
Sure.
shows intent. AI can now, which I already thought it was crazy. We all know the story of like how Facebook knew someone was pregnant before they knew themselves, right? With their things they were searching. It's so much more sophisticated than that now. So I wonder how you do that when you're competing against people who are utilizing that kind of AI.
Yeah, and not just the AI, but they're manning up as well. They're hiring a lot of staffers. They have large call center models. They're using sophisticated technology like AI. They have invested a lot of money in the infrastructure of being able to identify, hey, here's a good refi candidate, and we're going to make sure that we get in front of him or her before someone in distributed retail or another rival, right? So you're competing against kind of a smarter Terminator than you did in the last refi boom, right? And we know that nationally, the average LO is not good at retention. They're just not, right? And especially if you've been purchase focused. And in some ways, it's a lot easier to go after a refi. It's certainly cheaper, right? I mean, because it's not that they're not all financial considerations or deals, but there's a lot less emotion involved. It's very much a math problem. Here's what your principal is. Here's what I can save you. And here's what I'm willing to take for my comp, right? There are some LOs who don't want to cut their comp enough for that deal to make sense. And so I think that's where you see a company like a Freedom, for example, their costs to manufacture a loan are really quite remarkable. And this is where the efficiencies in the upcoming refi fight, I think, is really going to make a big difference. And a lot of LOs and brokers are out of practice with doing a lot of good refi business. It's a different script. It's a different set of considerations from the client. And, it's not going to be like it was in 2020 and 2021, where it was kind of a gimme, kind of an obvious one for every client, because how many people had mortgages at 7% in 2020, 2021, and you could get them down, like 550 basis points, right? So that's going to be a little bit different. And I think you're at a disadvantage if you don't have the right CRM, if you don't have the right playbook, if you don't have the right strategy. And people don't make decisions based on the CRM, but if someone gets to you first and it is a compelling offer and they have good customer service and they know how to get you in the door, you're not going to win that loan.
It makes such a difference. So I bought this house pretty recently. And, from the time that I had the credit pull and then got all of those offers from people, I had people who reached out 2 days later. And it's like,
Sure.
buddy, you are like number
You're late.
25.
Yeah.
Like, I've already like signed something, I mean, it's just crazy. Same thing. I just sold a car again. I had gone to, I had already like signed the paperwork, turned over the car, was back home. It was the next day. And the person was like, hey, you still interested? And I was like, I mean, a day in this day and age, if that's how fast you're responding, and that's why I know it's so hard for loan officers if they've got other stuff to do. It's like, how do you make sure you're just there? So I do think that CRM is super important.
I do think it's important. I think the more important thing is how are you not just utilizing the CRM, right? Think of the CRM as a tool. How do you communicate with people? How do
Yep.
you get your foot in the door? How do you remind them of the great service maybe you provided in 2020 when it was stressful and they had to bid over and the appraisal didn't pencil out, but they were able to use a reserve fund or, like whatever. If you were good at your job and you did something a little more complicated, how do you make sure that because it's not just offense, it's defense now too, right? And so you should still have a connection to those loans, even if the servicing right was sold to Mr. Cooper or PennyMac or Freedom or, whomever, right? Like that's not that it shouldn't matter. It does matter, obviously, but you
Right.
should still be able because you can probably offer a more personal touch since you did the deal in the first place, right?
And I think this is where I think that loan officers could learn so much from really good real estate agents. The really good real estate agents that like they're touching like human touch with you like 6 times a year. In valuable ways. They're figuring it out, and there are things that LOs could do like that. It's just they're not really set up like, or they haven't had to be set up like that in a while. So I think that's a challenge.
I think that's a huge challenge. Yeah. I think it's going to be the challenge of kind of the upcoming cycle when we enter what I expect to be a small mini wave. But keep in mind, like even these small mini refi waves are hugely beneficial to the LOs, to the lenders, especially the lenders. And the reason is quite simple. They're just much cheaper. They're much easier to do as an organization. Like think about all of the infrastructure and strategy and troubleshooting and know-how that goes into a purchase mortgage. It's just a lot greater than a refi.
It is.
And the margins don't have to be as strong to justify the costs and all the risk that one puts into it. And so, yeah, I think if you don't get a lot better at refis, if you're kind of an average everyday shop, retail or broker shop in America, they're going to eat your lunch. Like they've been designing their business around how to eat your lunch for a couple of years now.
Well, and I think, I just came back from the CoreLogic Core Connect conference. One of the speakers there was really a whole session on that was just the amazing amount of home equity we have, right? That people have
Sure.
not up to now have really not tapped into. And I don't know if that's just a leftover from, the fact that, I mean, you could say it's all about rates, but I mean, there are ways to do it, right? I mean, you've got the Freddie second that might be a way to do it, but you've also, I mean, we just haven't seen them do that. But I think those pressures, like you said, of the credit card debt that we know people are carrying much more right now. I'm not sure how much of that is homeowners, but carrying that. And then if we, even today, the 10-year yield, because we've got that, so we had the Fed meeting this week, then we had the jobs report came in, what am I trying to say? The jobless claims came in worse than people thought, so better for mortgage rates. You combine that, in a couple months, we could be in a situation where it really makes sense for people. We're talking about a point and a half.
Yeah. And then if you look at the employment paradigm, a lot of these gains that we have seen are coming from government jobs.
Mm,
That could very well change very soon, right?
great
And
point.
so, it's just another reason to consider that maybe this economy, although it's been pretty strong, I think pretty robust, all things considered, it's been certainly holding up a lot better than the Fed expected, right? But let's say we do have more job losses. Hopefully that also means we have more inventory in this country. Not that I'm hoping for job losses for people.
Right.
I think the soft landing is for the good of the economy, probably a best case scenario given how many people are locked in. I know not everybody believes in that, but I'm certainly a proponent still of a lock-in theory. But nevertheless, we do have a lot of big changes that are upcoming, and home equity is one of them that the LO, I think, really has never had to articulate because that has long been just the realm of the big banks and the credit unions, especially the credit unions. I mean, they just kill everybody on the rate. It's just so much cheaper to get that kind of debt. And the LO before Freddie's closed-end seconds just never really had a viable product. In a lot of cases, maybe they get a small referral fee. So hopefully that is something that could open up some options for people who don't want to do a refi or who don't want to have to sell their home, because you don't see a whole lot of other inventory coming, right? I mean, we do see what, about 30% of the market, give or take, still remain new home sales, but that's not going to last forever. We know that these home builders don't build in accordance to kind of what
Right.
we've determined is the the necessary number to hit supply, but it's going to be an inventory depressed market for some time, and so you got to figure out another way to make it work. And I think a lot of LOs that some of whom have already washed out, even more are going to hit, because the refis of tomorrow are not going to be as easy as they were last go.
Well, let's talk about you have some scoops. And just for our listeners, if you have a scoop that you want to share with our newsroom, James at hwmedia.com, reach out to him. He's your guy. He has his ear to the ground. He hears things first before most people. We've already reported on, obviously, the Mr. Cooper Flagstar deal, but what else might we see?
So yeah, we did break the Mr. Cooper Flagstar deal about a day before it hit. It was announced officially by any of the parties, so that was a nice feather in our cap. We've got a couple today that I think we're probably going to be publishing. We have already confirmed that these deals are happening. We have documentation for both, so I don't have a ton of details beyond what we have in the documentation, but I can say that one of the larger broker shops in the country, that's Garden State Home Loans, is being acquired by a regional bank in New Jersey called Ocean First. And so that'll be happening probably in the next couple of days. We'll likely see an official announcement there. And the second deal is maybe a little bit more interesting in some ways. And that is a Washington-based employee-owned lender called Axia Home Loans. We've written about them a little bit here and there. They opened a wholesale channel back in like 2020 when everyone was doing it, right? And they're selling their retail division to Planet Home Lending, based out of Connecticut. They're a big lender, do a lot of correspondent business. They've got a big book of servicing. So these are both interesting deals. The first, because we haven't seen a lot of brokerages getting acquired, and especially by regional banks. But regional banks do have to satisfy a lot of requirements on home lending. These are federally required statutes. And look, Garden State Home Loans has been a major player. It's been one of the biggest brokerage shops in the country for a decade or so, right? So that's a pretty obvious. I don't have a ton of details about the deal, but I think that in and of itself is pretty interesting. Obviously, they will no longer be a part of the broker space moving forward. They'll be part of the bank retail operation at Ocean First. The second deal with Axia, this is interesting because an employee-owned business it's hard to sell, right? Like, it's complicated. You have a lot of different stakeholders. I don't have a lot of details on this one. The companies have not shared officially anything yet, so this is really hot off the presses. But I've been told that some of the employees who are not transitioning to Planet, their final day will be Friday, August 2nd. And
that's tomorrow. I mean, that's when this comes out. That's pretty quick.
Yep. And hopefully I'll have more details to share later today.
So that first one, Garden State, that's Anthony Casas' original.
It was, yeah. That was his lender before he moved over to Open U Mortgage. Yep.
Okay, that's interesting. Obviously, he's somebody that most people will know in the broker space, especially. So, really interesting to see. Like you said, those aren't your typical. Neither one of them is really typical, and so interesting to see how they're combining. But they make sense, like what you said. I mean, it totally makes sense that the lender has to. The bank is looking to fulfill the CRA requirements or whatever they have to do to make sure they're lending in those communities. But that's not something that I would normally think of.
Yeah, I mean, it does happen. We haven't seen a ton of it because the banks have obviously, the depository banks, that is, have retreated a little bit in mortgage in recent years. They have a lot of regulations that they need to comply with, and mortgage just isn't as profitable as, their, as other operations. And so we haven't seen a ton of it, but yeah, I think it's a pretty interesting deal. Not great news for the broker channel,
Yeah.
obviously, but we have seen a lot of retail LOs who have become brokers. And we have seen some movement there. Or you might remember, Sarah, that we talked about this a couple of years ago when Matt Ishbia and Katie Sweeney and all
Yep.
kinds of people were saying this is going to happen. We're going to see a massive movement from retail to wholesale. And I don't think it's been massive, but definitely probably north of 10,000 have moved over. Like it's significant. And you have to consider that there's a lot of flexibility in the broker channel, especially with borrower paid comp. You have, I think, also more sophisticated actors in the
Mhm.
broker space these days, and especially at that level with kind of the C2s and the Nexas, and there are a lot of really solid shops that have good technology, have good CRMs. It's no longer like, okay, you have a desk and you have our name, the ability, to sell to all of these companies. It's a lot more support if you need it. It's also, if you don't need it, you don't have to pay all that much. You pay a flat, number of bips, or you pay a flat dollar amount. You pay $800 a month or whatever it is, and that kind of covers the infrastructure that you need. So I think there's a lot going on in the broker channel, but you can't talk about the broker channel without acknowledging that UWM is just so much bigger and so well established in that space that almost all of the big players outside of Rocket, which they were doing a lot of business back when the ultimatum came, they were certainly uh, on UWM's heels. And now there's a lot more separation. It's a different game. And a lot of the other rivals aren't there. They're just
Yep.
not participating. Loan Depot's not there. Home Point's, in the ground, like, et cetera, et cetera.
And it goes back to, I remember we wrote a series of stories in 2022 talking about who are going to be the winners and losers of this market as we saw the, massive changes coming from the Fed rate hikes. We're like, what does this look like? And I think a lot of those predictions have proven to be correct, right? And a lot of it is
Yep.
like the companies that went public and have that sort of capital are just at such an advantage.
They are. I mean, there's no way around it. It's just a lot easier, a lot cheaper to get debt from the public markets than it is, if you're a company that doesn't have that sort of credit availability. It means you can take more risks. It means you can be a little bit more liberal on some policies. I think it gives you that extra 15 to 20% that others don't have. And when it's really dire, when the originations market is tough, when loans are at 8% and nobody's doing anything, you have the cash, you have the lines of credit where you can hold on, and maybe someone else is no longer in compliance with Fannie and Freddie, or maybe you know, their warehouse lines are looking pretty thin and dry up, right? Like, you just have way more protections. And so, yeah, I mean, it's, in that respect, it's also interesting that a couple of those lenders that went public didn't last. They ended up getting sold for servicing rights, basically, in the end. And regarding that story that you mentioned, when we look back at who's primed to survive, and not just survive, but do pretty well in this marketplace, it is a lot of the players that we expected, the large servicers that have the money coming in from, nobody's refinancing their 2.8%
Right.
rate, mortgage, right? Even if it's not a lot of bips per
And
month,
not
like,
paying it off,
collectively,
because why would they? It's cheap money.
right?
They're not paying it off
Right. The
either.
prepayment speeds are like, yeah, whatever the opposite of Sonic is, it's like sloth. And and then you have the big companies like Rocket, UWM, again, like, they have moats. They have just the scale that few others can achieve, and you can really weaponize that scale when there are fewer loans to fight for. You can have, initiatives like Game On, or your Rocket, you can, you can just do a lot more with pricing. You can just do a lot more with marketing too, right? You can fight in a different way that others like, who's going to spend 10 million, $15 million a month in marketing in mortgage when
Whew, yeah,
everybody's in the red each quarter,
yeah,
like Rocket can do that, right? Like they can
right.
still sponsor, they can still do a lot of, important work that maybe doesn't get recognized in a kind of a classical sense, but is just as important for the consumer acknowledgement.
All great points. Well, again, if you have a scoop, James at hwmedia.com, and make sure to check out our homepage because we have all of this coverage. James, thanks so much for being on.
Thanks very much, Sarah.